We know that individuals, when they need to purchase real estate, or companies looking to purchase commercial spaces, need huge amounts of fundings in order to make the purchase. Since it's challenging to finance the real estate all by themselves, a possible way to raise the money is through mortgage loans. So, what is a mortgage? It is a type of loan taken by individuals and corporations to purchase real estate. In case of a mortgage loan, the property itself serves as the collateral to secure the loan. Usually, financial intermediaries like mortgage companies, saving institutions, and commercial banks originate these mortgages. These financial institutions then obtain their funding through household deposits or by selling these mortgages to institutional investors in the secondary market. Uh, rather than selling the rather than selling the mortgages outright, they can engage in securitization of those mortgages, which is they combine individual mortgages together into packages, turning them into securities called mortgage-backed securities. By doing so, they are able to create mortgages even if they do not have the funds to finance the mortgages by themselves.
Today, our focus is to explain collateralized mortgage obligations (CMOs), which is a type of MBS. So, what sets CMOs apart from a traditional MBS is the fact that mortgage loans in CMOs are classified into tranches, mainly based on maturity date and risk factors, and then are sold as a single investment. These tranches differ from each other in terms of principal payment, interest rate, maturity date, and the risk of loan default. The cash flows from these tranches are arranged in a sequential manner. Any repaid principal is first paid to the owner of the first tranche until he is paid fully, then to the second, third, and so on. This process continues until the owner of the last tranche is paid fully. Sometimes these tranches are segmented into interest only, where the owner of the CMOs gets the interest payment only on the underlying mortgage, and principal only, where the owner of the CMOs gets the principal payment only.
Financial institutions who purchase the CMOs do not own them directly. Rather, they own the bonds issued by the CMOs. Their investments are based on their requirements of a bond's particular risk level, interest rate, and maturity. CMO issuers receive cash flows as borrowers pay their loans, and then they pay their investors while charging a fee for serving the mortgages. Loans in tranches that are considered to be at high risk are usually taken by borrowers with lower credit scores, thus making them more probable to default on the loan.
Even though CMO brings great opportunities for investors, risks associated with it can be a problem. Return can turn out to be lower than expected if borrowers prepays their mortgage too early. When many of the mortgage holders default loans, holders of CMO will lose money, and market risks such as a large number of borrowers will refinance their loans and pay off their borrowed money too quickly.